Good morning, ladies and gentlemen. By my calculations, we're about minus 25, so still moderately negative in risk off. And I think there is absolutely no relief from what bond yields are going to do and keep on doing. We will examine where bond yields are going, and while we are under the targets, I think the path of least resistance for everything is still way lower in everything. Bond yields and equities are still tied together, and there will be no lasting rally until bond yields bottom, and we'll now examine where that could be. The real problem is that we have no definition to any of the charts in anything but a monthly time frame. So this is the twos, as you can see, and really I have nothing till 475, 499. I think that area will be touched, and that implies at least 275 basis points tightenings by the Fed this year and a little bit more next year, and then probably something like several months of sideways trading at best. So this is really our best case scenario, that we get and meet those targets and then do something like here back in 2006 and go sideways. Whichever chart I look at, whether it's the twos or let's go for the threes monthly, I really have nothing in threes until 5%. And in fives, the target area really is 449, where we were basically trading when the twos were last at the prices that I showed you. So this is the area that we are going towards, 4.5% in fives. If we look at the tens, we have really 428 as a very important area. So we're now at, what are we, 402-ish. Another 25 basis points in everything, basically. Even close to the 30s, which are going to 419. That is the best that I can see. You can see all these lows here. That's what we're going to test. We're going to break these guys, and basically everyone is going to be scrambling. Bond yields are just a wrecking ball. They're going higher, least of all in the 30s, but enough to do some serious damage to expectations and to equities. You know, there's just no respite here, and there won't be for a while, I don't think. Any rally, you just sell it and you hope, and you go away. I'm going to try and give you a weekly chart, but what does that tell you? That tells you only basically that we are through a level that we were at in 2013, and that we are going higher to this 419 area, which is very important, and that's why I'm short some 123 puts, but I am, I am short the twos and fives. So all I can do is make less as opposed to lose money. I think there will be quite some tug of war here at the 419 area, and hopefully several weeks of sideways trading before we decide what we do next. But I fear that we will still break higher even after that tug of war. This is just relentless, and I see absolutely no reason fundamentally or technically why it should stop. The yield curve is really not giving us any clues, simply because it's almost a parallel shift up in everything. Current prices, the ones from a week ago. As you can see, yes, the pressure is more at the short end. You got 22 basis points in the twos and the fives you've got 16, and then in the T-bond you've got 13, and in the ultra you've got 13 as well, just short. So the long tenures are 20% less than the very short tenure, but it's almost a parallel shift. The danger still is that something like the fives gives up and goes and makes this curve lose the kink in it and more or less go straight. That is the danger still. As I've told you several times, I haven't seen a topping out in yields without the fives, the belly going berserk and giving up. So that is quite possible that it happens at some stage. When, I have absolutely no idea. But what I'm saying to you is that while this pressure on the yield curve continues, you do not want to fight any particular tenure at any particular level. You just got to get short at some stage. Fundamentally, there is absolutely no reason not to be short. The yields at the very short end in the euro dollars are telling you that this is going to last a very long time. Months, not days, not weeks, but months. And therefore, all you're looking for is places to short. And the yield curve is not giving us any particular clues. It's just basically saying the pressure is still on. This is now a weekly chart of the 2s, 10s. You can see that by that box here. If we change that to a monthly chart, you will see why it's so important. This is going all the way back to 1989 and then the episode in 99-2000. And you can see how long these episodes can last. They can last very many months. There's 1, 2, 3, 4, 5, 6, 7, 8. So basically best part of a year before the yield curve then has done enough damage to the economy completely craters and the Fed is forced to ease, and then the 2s, 10s collapse. Are we going to have a repeat of that? Quite possibly. But I think the likelihood is that we still keep on going in the 2s, 10s and we reach levels that we haven't seen since basically 1979, 1980, which would be around the 80 basis points, something like that. I.e. the pressure is still on. The pressure is still on. If we have a look at the 5s, 30s, which is my favorite indicator, we got to 42, 43 basis points and backed off. But the pressure is still going to continue. I really would expect this 42 to 60 area to be tested and for us to remain there many months. Don't forget, this is a monthly chart. On the weeklies, you're not going to see anything at all. I can change it to the weeklies. What are you seeing there? You're seeing, yes, that there's resistance at 42 where I marked it. And yes, there's a resistance at 60, but you can't really see it. Going back to a monthly chart, that's all we can do. Those are the areas that we are likely to get. So what does that tell you? That tells you, yes, the pressure is still going to be on the 2s and the 5s, but it's not like the 30s are going to love it. What it really tells you is that you want to concentrate your shorts in the 2s and 5s, and then, as I have done, try to sell some puts against that position in the 30s at some stage below the market, hoping, very short dated puts, hoping to make some money that way. But that is all that the yield curve is saying. And the other thing it's saying is that this pressure is going to last a long time. I don't think this economy is just going to give up from one day to the next, and then you get a complete collapse like you did back in 1989. In 1989, things were completely different. I think the Fed is going to keep the pressure on, and in 530s, we're going to basically trade from these levels, i.e., 10 basis points, 0 basis points, 10 basis points, up to 42, up to 60. And then only after we've exhausted ourselves, trading 6 months up here, are we likely to see any kind of a reversal. The pressure is just relentless. It's no different in Germany. This is the twos, the Schatz. This is a daily chart, as you can see from this. Every time that we drop in yield, we return to where we came from. I mean, the trend is very, very strong. The danger is still very much to the upside. You won't see very much on this daily chart, nor on this weekly chart, but you will see it very clearly on the monthly chart. And this is it. We are closing at levels which basically indicate that 268 is our next target, 268, 270. Another 50, 60 basis points even in the twos. There's, any level, any chance that I get to buy cheap puts, you should take it. If we go to the bubble on the monthlies, I think there's very little doubt that at some stage we trade 245 and possibly extend to 285. I don't think the ECB can stop this pressure. Any kind of move down towards the 160s, and you have to buy it. And in the Bund, we really had a very, very bad close. I don't know if I can show you on the weekly chart. Very bad close, and the odds are that we extend to 286 here. On the monthlies, you can see it. Sorry, that's 289. Those are the odds that we extend to at least 289 before coming back. Absolutely no reason to be long of Bunds, absolutely no reason to be long of Bobble, absolutely no reason to be long of Schatz. I think the pressure should be more on the Schatz than on the Bund, but there is absolutely no reason to think that any of these have topped out anywhere near before they get to at least these targets that I'm showing you. In the crosses between the Germany and the US, this is twos against twos. I gave up the idea of selling at 255. This is a monthly chart, and you can see that every time it goes to 255, it goes to like 350. So that's too much risk to have that trade on until it fundamentally makes sense. And at the moment, it doesn't really fundamentally make sense. It hasn't moved very much away from 255, but that only tells me that if I am short of 2-year notes in the States, then I can't really even think about being long the Schatz. It could easily extend to this level next week, 270, and then 280. The risk reward just isn't really particularly there to put that trade on at the moment. It's a trade I've got in the back of my mind, and I will continue to have in the back of my mind. But at the moment, it really doesn't make that much risk-reward sense. If I change that to a 10-year, you can see that really we are doing nothing. I still think that at some stage, inflation, being a global phenomenon, will force this down towards the 100 level. But it fundamentally isn't happening at the moment. You're really looking for these higher levels to sell around 190. That makes sense. Down here, it really at the moment does not make sense. But what this chart tells you is that these yields are still tied together. And if you're bearish the US, you cannot be bullish Germany. It just doesn't make sense. You might make 5 basis points, you might make 10 basis points, but the differential is still very much tied. Therefore, you are looking to sell everything at those decent levels that I showed you. Last chart I want to show you here is of the French 10-year note. And really that has been technically trading very, very well. And the level here is anywhere between these monthly closes around 320 and this level here, which is 340. 320 to 340 basically is your target in the French market, and given that we're at 292, that basically indicates that there's another at least 20-30 basis points in everything, in 10-year notes in the US, in bunds. That one really will trade these levels, and that should top us out for a while, and then we trade sideways. Just showing you at least another 20 basis points in just about everything. And I just wanted to show you the euro dollars. I mean, if you look at what the euro dollar curve is doing, it just gives you no hope for the shorter tenures of the bond market. And since I've showed you what the yield curve is doing, basically almost parallel shifting, it gives you not a lot of hope for any tenure. While, I mean, if you have a look at Z22 new lows on the whole move on Friday, right? We just could not rally at all on Friday, regardless of what the bonds were doing, regardless of what the bunds were doing, which were up nearly 200 and, stupidities like that. If you look at H23, new lows. If you look at M23, new lows. U23, new lows. So, and you look at the values, this is all over 5%. So if you can get over 5% in 3-month money from a bank like, JP Morgan, why would you be particularly keen to buy treasuries in the low 4s? It just doesn't make that much sense. It just shows you that there isn't going to be that much support, and that the market all needs to go up some more to find the buyers. The first time we come under 5% is Z23. So if you got a whole year of receiving more than 5%, why would you particularly want to be interested in buying the 2-year note, at 430 or something like that? It's just not going to happen. It's just not going to happen. You're going to get everything go up at least another 20 basis points from where we closed on Friday. If you're a bond bull, this chart has really got to have you worried, okay? Because we keep on bouncing in terms of expectations from around the 210 area, which is, only very slightly above Fed levels, Fed target levels, and we keep on bouncing despite the fact that bond markets are doing what they're doing and the yields are going up. So now on Friday we have 240 expectations for the 5-year, and if I change that to a 10-year, we get to the 215 area, which is just slightly above where the Fed target is, and we're going to 240, and we're probably going to 250, 260. And this is still despite the higher Fed yields. What the Fed would like to see is this to remain stable at 2 or below 2. The fact that they're always bouncing from around 2% is going to give them no comfort whatsoever, and is going to just keep them on the tightening path. The only question is whether they do 275s and then a 50, or whether they do 275s and then a 25. They would like to do, a lesser number, because as I wrote in my piece on Friday, they are beginning to get worried that they're going to break something. They would much rather not break something. But I don't think it's up to them. I think the market will tell them when they're breaking something, and until that happens, they're just going to have to keep following the market. I don't think the market would like it if they started doing 50s now. I think the yield curve would not appreciate it. I think the long bonds would have a very tough time compared to the 2 years. I think the yield curve would come in a lot. So, and I'm sure they don't want that because that's not very good for equities. So they really have to follow the lead of the 2 years and tighten as much as 75, both now in November and in December. So we're talking about, you know, sort of everything falling together. We're looking for that 475 area in the 2 year to trade in you know, over the course of the next 2 or 3 weeks, which gives you all the levels that I've given you for the other tenures of the yield curve. And those US bond yields really translate into the wrecking ball that is the dollar. I mean, the US dollar cannot come down. Dixie cannot come down while the yields are doing what they're doing. All that happens is you get to overbought levels, and then you go a bit sideways, and then you go up again. And that is what we're doing at the moment. We got to very overbought levels. We came off to a support level, and we're going sideways, and then we will go up again. And while this pattern lasts, absolutely nothing here tells me that we're not going to reach those levels. If I enlarge and go back, that we were back here in 2000 and 2001, where we got to 116, 118, and possibly 120. And you can see how long this lasted. This lasted best part of 2-3 years. So while this lasts, I can see absolutely no respite or no fundamental reason for any respite in the dollar. And dips should still be bought. Anything down to around 111.31 is probably a good level on a weekly basis, and on a daily basis, really, you're looking, maybe 110s, but that is all you're looking for. There's absolutely no fundamental reason to think that the dollar is topping any moment soon, simply because bond yields will not allow it. And while bond yields are doing what they're doing, the Dixie is doing that because of bond yields. Gold really cannot rally and sustain a rally. That is pretty obvious for the time being. There is really no reason to think that we are going to bottom anytime soon. We will bottom in gold when real yields have topped. How long will that take? I would have thought it's going to take at least another 6 months. And by then we are likely to be somewhere down here, 1500s, low 1500s. There's absolutely no reason to think that we are anywhere close to it. Gold will bounce like a bitch once the real yields have topped. But I don't think they have topped, and I don't think the likelihood is that they top for many, many months, let alone weeks. In which case, why own gold? Why particularly try to be a hero owning gold? Makes absolutely no sense whatsoever. I was surprised that DBC was really as weak as it was like last week. Or rather, I was surprised that it didn't even try to go up a little bit and touch this 26.93 level. That tells me it's more likely to retest 24.39, and that tells me that we're not going to get any huge pressure in oil next week. So if we have a look at that, surprised it didn't even try to touch the 98 area. And we are still below the 200-day moving average, which is still trending slightly higher. But at some stage, even that has to start turning. So, what to say? Probably more sideways between 80 and 90. But, there's absolutely no reason to think that it's the 75 area is in danger. The 75 area being in danger would really signify that the commodity markets are saying that the demand rather than the supply is disappearing. But I think that will, if it's going to happen, it's going to take many months for that to happen. And the bond market needs to exhaust itself, and it needs to show signs of coming around and accepting that the economy is completely screwed. Are you seeing any signs of that in the twos or the fives, which would reflect it most, or the Eurodollars for that matter, which would reflect it even more than the twos? You would really need to have that curve in the in the Eurodollars go at least flat for that kind of thing, for the market to start expecting that. No sign whatsoever. So really the best we can hope for here is a sideways, and anything below 80 is a quick short-term bounce play. We haven't looked at the Blue Angels for a bit. Basically what they're indicating is that with the bond market doing what it's doing, it's very hard to see multiples going higher, or the market trading higher multiples. Why would it? And while expectations are still flat, everyone acknowledges that really they're down a bit. So we are really at trading something like 15 to 16 times multiples, with a tendency for the multiples to fall, and with a tendency for the E in P to fall as well. This tells us really two things. The market is going to remain weak, and secondly, the market really, without bonds, cannot rally at all. Why last week we did what we did, who knows? Some internal, somebody bought, somebody got stopped. It really doesn't matter. Every time you see a discrepancy in bonds against equities, the bonds are going to be right. And this is why the stocks and the bonds are really doing the same thing. We have been in a very large range, but fairly stable, as it turns out, from what? This is 2021. March, April of 2021. This is SPY over IEF. So what's that? That's the 6, 7, 8 year area. It's stable. Their stocks and bonds are just following each other. Stocks are doing slightly better against TLT, but that's because of duration. But it's still not, to me, not a trend. It's a nervous stability. The two things that give food for thought is that finally SPY over XLY is going higher, which basically means that XLY is hugely underperforming, and it's basically saying that the problem is going to be in the consumer. If we look at equal weighted consumer discretionary against consumer staples, that is also rolling over, saying that there is going to be a continuation period of weakness in discretionary spending. And how it would be surprising if that weren't so, with what bond yields are doing and what a wrecking ball, how they're wrecking the mortgage market, and how they're therefore wrecking people's disposable income after they pay their mortgage or their rent. So those indicators are all showing risk off. And ITOT over government, so the totality of the stock market over the totality of the government bond market, is basically stable since, March 21. Okay, so even earlier, that's February 21. So in in all that period, it's saying that we are back in the relationship between governments and the totality of stock market where we were in, say, February, March of 2021. And now we have a look at where we were March and April, Feb and March of 2021. And here we are. This is where we were in February and March of 2021. We were between 37.11 and 38.61. But where were bonds? Okay, the totality of the bond market was huge amount lower in yield than it is now, and higher in price. And therefore, it really would surprise if the stock market could sustain unchanged levels. For that to happen, we would need to get a significant correction in that ITOT government chart I just showed you, a correction upwards. That is unlikely to happen, and while we have that relationship between ITOT government and SPY IF and SPY TLT, any kind of rally into this 37 to 3800 area just cannot last. It can last a week or two, but that's about it. I think the likelihood is that at some stage we test these lower levels around 34.25. This is, you can see, well, this is a weekly chart, of course, and you can see that we keep on bouncing off the Bollinger Bands and going back towards this middle line. But we are testing lower levels and bouncing, testing lower levels and bouncing. So really, you're looking for the market to touch very important levels. I've written those down in the summary sheet, and only at those levels you do some call spreads and you wait for the market to bounce 100 and you get out, because it's not going to be sustained, not until bonds give the all clear, and they're nowhere near to that. When in doubt about levels, always go to my clean chart. To me, it's very, very unlikely that we don't trade 34, 28, 29, this level here, and fill these gaps that we created back in Q4 of 2020. Which are down to 33.85 and things like that, 3,300 basically, let's call it. These gaps here, they're like 1, 2, 3 gaps. I think I've said it all. The bond market and the stock market are tied together. Yes, the stock market can do slightly better than the bond market, but not very much. Any kind of, and I can enlarge this, any kind of move back up to these kind of level 37.25 is a sell. Is a sell for what? For these levels, 34.28 and so on. While it remains below 36.45, the pressure is going to be very, very strongly to the downside and to fill these gaps. I have no doubt that that's going to happen. I think everybody who's looking for a strong Q4 is going to be disappointed. They might get a better performance, i.e. less negative from equities, but they're not going to get a positive one. because the bonds are just the wrecking ball and they're just not allowing any oxygen into, it's all in a string. The dollar does what it does because bond yields are doing what they're doing, and that all eventually pressures equities lower. Volatility still tells me that maybe things are not going to get so bad, but they're not wonderful. As long as we are above 30.11 in VIX, in cash VIX, the pressure is still there. We're getting, red closes on the weeklies. These are like 3 red closes on the trot, and yet the market just cannot rally. While this line, while we're above it, the pressure will be sustained, and the danger is always for more spikes. So really no room for complacency whatsoever. Every time equities rally a little bit, I tend to buy a little, small position in puts, and it keeps on paying off. So I see absolutely no reason to change strategy. The strategy is both fundamental, i.e. The Fed is tightening, the Fed is doing QT, bond yields are going up as a result, ITOT over government is tied together, the bonds and the equities are fundamentally tied together unless the economy can show a completely, that it's falling apart, in which case you will get a big move in ITOT governments eventually, but I think it's going to take many, many months for that to happen, and for the Fed to realize that, if it's going to happen. And therefore, still for many, many weeks to come, equities and bonds are going to be tied together. Every time there is any kind of disparity between what they're doing, and to just look at the bond market and not at the equities. I have updated all the levels, but I think the strategy for next week is clear. Every time there's a dip, you buy it in bonds, bond yields, you buy it. Every time the futures rally, you're looking to sell. With these levels here in mind, once we've reached them, we're out. But until we've reached them, there's absolutely no reason to expect equities to bounce, and there is, or to bounce sustainably. And there's absolutely no reason to expect that these kind of levels will not be touched in equities if the bonds go and touch these levels. More of the same, but that is really what the central banks want, more of the same, until the pain squeezes out the inflation. And that takes time. It takes a long, long time. So there's absolutely no reason to change our strategy. It's worked very well, and we shall continue to apply it. Thank you very much indeed, and tweet you on Monday.